Hi, I'm Julie Smith-David at the W.P. Carey School of Business at Arizona State University. And this video is going to introduce you to the concepts of the resource event agent model. This model is used to document how an individual organization within a supply chain adds value within that supply chain. The basic elements of the REA model are resources, events, and agents, and these occur in a pattern that can be used to describe all economic endeavors. Basically, businesses are in business. Businesses perform exchanges as part of their business routines. An exchange is we get some resources, but we have to give some resources in exchange in order to get them. Once we understand what the exchanges are, we can identify the associated resources and agents who participate in those exchanges. If we model every process in the organization, we're able to trace all of the resources throughout the organization. And if we do this and capture that data in detail, we're able to use that as the foundation for all accounting information and financial statement generation. It's beyond the scope of this video, but if you capture data through the REA model, you don't need journal entries to produce basic financial statements. I know that sounds as heresy, but that's the foundation of Workday's enterprise system. So in fact, that's becoming a more common model than it's been in the past. Throughout this video, we're going to use UML modeling techniques to draw the diagrams, but you don't need to be an expert in UML to continue. So let's keep going. So the basic REA pattern recognizes those economic exchanges as the foundation for all business activities. And so when you're doing the modeling, the best place to start is to identify what are we giving and getting in this exchange. And those exchanges are two separate events. They may occur simultaneously. They may occur one first, the other one second, but they're linked together because that's how we're going to add value. We're going to bring in some resources, and hopefully we're going to be able to produce something that adds more value. If you can identify the exchange, then for every event, you extend the model by recognizing what's the resource that's either being increased or decreased, and who are the parties who are participating in the exchange. There's always at least one inside agent, the person who's responsible for the transaction, and one external agent, the entity with whom we're having the exchange. We do that for both of the economic events, and this is the basic REA pattern. So when you're doing REA modeling, set this in your mind as the general structure to which you're working. Now, it doesn't matter that the resources are on the left and the agents are on the right. It doesn't matter which economic event is on top of the other. These models aren't read left to right or up and down. It's the associations between the classes that really matter, where we just say this is related to another class within the model. So let's go into it a little bit more. What's a resource? A resource has a very specific definition. It has to meet these three criteria. It has to be under your control, add value, and is scarce. So can you think of some resources that are in organizations you've worked with, or organizations that you've bought things from? Well, probably you thought of things like inventory, cash, maybe buildings, factories, equipment. Those are all accounting assets. And in fact, they do meet this definition of being under your control, adding value, and they're scarce. But additionally, resources would extend into the service space. Think about your employee time. Employees are generous enough to give your organization perhaps 40 hours a week, and that's under your control. I hope that it adds value, and it's really scarce. The moments as they tick away disappear instantly. So employee time, advertising service, legal service, all of those are also resources in REA modeling. Economic events are those that increase or decrease the quantity of a resource. So you can think about buying inventory, writing checks. Those are economic events that increase and decrease resources. The internal agent is the person within the organization that's responsible for the transaction. So you can think about it, there's the famous quote within businesses, who's the throat to choke? Who's really responsible for that transaction? The external agent is the person, if you know that person, or perhaps the entity outside of your firm that's also participating in the event. The associations are also named in the basic REA pattern. Stock flows are the relationships between economic events and its resources. Duality is perhaps the most important. That's the relationship between the increment and the decrement events. And it really shows why are we willing to give up a resource. So if you have a cash disbursement, your organization is only going to be willing to give away cash because it's getting something in exchange. Maybe it's buying inventory, maybe it's buying a new computer, maybe it's paying for advertising time that you're going to get to use in the future. All of those would be, those pairs of events would be linked together through duality relationships. So what would it look like for a real process, the sales process? Again, this is the basic template with the resource event agent, two events being linked with a duality relationship. Well, if you focus in on the events, what really happens in a sale? What's the increment and decrement event? Well, in a sale, we're really hoping that we have a cash receipt, and because of that cash receipt, we're willing to give up inventory in a sales event. Now, you might call these things, different organizations may call them different things, but in this organization, they're called a sale and a cash receipt. In other organizations, maybe the sale would be called a shipment. The cash receipt might be called a remittance. But the reality is the cash receipt is the increase of the resource cash. And that's usually the responsibility of an accounts receivable clerk. That cash receipt comes from a customer. That customer is willing to give us the cash receipt because of the sale in which we gave them inventory. So a sale decreases the quantity of our inventory resource and is the responsibility of a salesperson. So that's what the model for the sales process would look like, the basic model. We can extend this model by adding additional events which allow us to capture more information that allows us to better manage the process. Events that provide more information are referred to as business events. They support the economic event, but they're not the final outcome. No one is going to be happy if we only perform the business events. They're not going to be happy until we perform the economic events. So let's think about a customer order. A customer places an order and tells us what inventory they want, how many, and what they're willing to pay for them when they want them. They give us a lot of information that we didn't know before. So that information is really valuable. It's going to help us plan all kinds of activities. The obvious one is the shipping, but also we can use that data to go back through the supply chain to plan our production, to even do sales forecasting, labor scheduling. There's many activities that could use that information. So we know that it's important. There's new information. This business is enriched by getting that information. So even though that event takes a little bit of resource, let's say that the salesperson captures the customer order and used 5 minutes of their time to capture the order. Well, there's an economic impact, and we want to be able to track that. But no one would be happy if the customer just placed the order and nothing else happened. So the order isn't the final outcome. The final outcome is the actual exchange, the sale and the cash receipt.